Welcome back to PDAC 2024 for a more serious topic. Not to say that all the other companies we've been discussing have been light, but this is very serious and very important to Canada's mining industry. We're talking about raising flow-through, and the road to flow-through and the road to mining goes through First Nations. Without flow-through, a lot of parts of our communities are going to be hurting. Today we have Mr. Bernbaum from Peartree, an expert in flow-through financing.
Oh, thanks so much.
You're welcome. It is true. You've only been in the industry how many years?
About 17 at this
About 17.
Yeah.
So I'll call you an expert. For those of people who don't know, why don't you describe what flow-through financing is?
Well, historically, flow-through financing is merely the ability of a junior mining company, exploration company, to raise public money, where the funds that are being used are used for future exploration, for new exploration, and the deductions that any other company might take in hiring labor or otherwise are flowed through to that first subscriber who's funding that activity.
It's almost like a limited partnership.
For tax purposes, it's exactly like a limited partnership. A company raises $1 million, it has to spend $1 million. The umpire here is CRA, so the tax authorities say, if you properly spend it, there's no issue, and it's easy to spend money.
Right, so that's on drilling, mapping, sampling, engagement with First Nations, all count for flow-through. Flow-through.
And at this point, the flow-through regime is all, well, not this point, but for as long as I can remember, most all equity for juniors come through the flow-through regime. So, 90% of all exploration dollars are deployed through flow-through, and that's about $1.2 billion a year. And then we added a variation on that theme back in 2006-07 with the advent, which is the charity flow-through piece.
Right. We're going to leave that part to the side. That gets a little confusing, but you can talk about that later. So flow-through is actually called a government incentive security.
Yes.
It's right in the Income Tax Act.
It is.
You and I were chatting that I had an accountant tell me last year that it doesn't exist.
Okay, I think I would find that to be. That should be an ex-accountant. I don't think I've ever run across an accountant that said it doesn't exist. Yep. The flow-through funds used to dominate the space. There were funds that were set up by Ned Goodman was
like a mutual fund or LLP.
Where the LP would then go out and buy flow-through shares in the companies. And in the old days, there was two sources of capital. One were the flow-through funds, and the other one was direct retail sales. Right. Well, there are no more brokers calling you and saying, Sarah, I got this great deal. It's Cisco, it's newfound gold. You should invest. It's only 83 cents. That doesn't happen anymore. So anybody who's buying flow through once removed through the flow through funds, which represents like 10% of the market, are doing it purely for tax value. They have no clue what there's no direct linkage or very little direct linkage between the company itself and the investor, so and that's really unfortunate.
The mutual fund holder doesn't care what the mutual fund buys.
Not at all. They're in it
as long as they get their tax credit,
and as long as there's a tax credit, and then and as well some after-tax returns. So in years when those limited partnerships, 9 Point's a good example, or Maple Leaf, for example. If they're showing decent returns, then they can continue investing. But the reality is they're not raising a lot of money anymore because the returns in the space have been less than stellar.
It's been a tough couple of years.
It's been a very tough couple of years.
And the government of Canada is not helping much with the changes around alternative minimum tax. Now I know it's a complex subject. We don't have the days it would take to cover it. But the changes to AMT are impacting flow-through.
Oh, for sure. Basically, the best example of a tax incentive is, just to step back and maybe give you the foundational piece for a minute. In 2022, the federal government did something very smart, and that is they introduced the critical mineral exploration tax credit, which was a 30% tax credit. You buy $1,000 of flow through, you write off $1,000 if it's for exploration in critical minerals, lithium, cobalt, whatever. You would get an additional $300 of tax credit, which is actually ratcheted back the following year. And that was a very smartly timed, and we understand a response to the U.S. legislation that to compete against the United States in the Inflation Reduction Act. From April 22 to the end of March 23, the first 12 months, $350 million of accretive investment came through the flow-through regime. Flow-through shares issued to fund exploration. Our clients, we did $225 million of that.
That's a lot.
But a tax incentive is only as good as the access to the tax credits and deductions. In order for somebody to buy $100,000 of flow through, they need about $600,000 of regular income just to write it off. In our format, they need closer to about $900,000 of income because the shares are not kept; they're donated and sold. And so the result is that these new AMT rules add back into your income, take away some of the deductions and credits, and basically, all other things being equal, the AMT rules that are supposed to come into effect as of January of this past year, January 1, 24, will reduce all flow through and all exploration capital by about a third. We're talking about $300 to $400 million.
That's the number I keep hearing getting batted about. Now it's
a huge number.
There's a budget coming up in April of this year, and there's some hope that there'll be clarification or edits to the AMT rules.
Yeah, we are. This is sort of, I feel like the I don't know if the great Hallmark movie or the great movie, Princess Bride. You know, this issue isn't dead; it's nearly dead. You know, Billy Crystal.
Great movie.
It's nearly dead. The government is very desperate for additional tax income. The AMT rules have broader application against capital gains, especially, and flow through shares are particularly exposed to capital gains change in the AMT rules. The result again is people will only be able to buy about 2/3. Quebec's a little worse, maybe only 60% of what they previously bought, in order to access all the tax credits and deductions. And the reality is, if they're not accessible, who's going to buy them? Well, there goes the incentive.
So you mentioned Quebec. There's not just a national aspect of flow through. Each province has its own mechanisms.
Each province has additional, not all provinces, but most provinces have additional tax incentives to invest in exploration in that province. Quebec understands tax policy better than any other jurisdiction, probably anywhere. I mean, I can tell you that my background is I have a law degree and practice tax. When I got the first ruling back in 06, 07, and then the follow-on tax rulings from the CRA, they're very sort of, they read the Income Tax Act, they look at it through the lens of lawyers, more or less.
Yep.
Quebec was a very different experience. It was, what our current credits are, what we're currently giving up. Show us the debits and credits. Show us that we're no further behind or further ahead in your format. If it works, we'll do it. They're very pragmatic.
Right.
And they're very supportive of what we're doing, but they're very supportive of the mining industry. And, I mean, if you saw the Pierre Lassonde-Goustra article in the Globe and Northern Miner, I think, that talked about the pension funds not investing.
Right.
In Quebec, they actually do invest. And Investissement Quebec, the Caisse, they invest in their own mining industry in Quebec, nowhere else in the country. But each of the provinces have added additional credits.
Saskatchewan's pretty good.
Saskatchewan now 30%. The problem is there aren't a lot of taxpayers in high. There just aren't enough taxpayers in Quebec, in Saskatchewan rather.
Now, that's not to say that individuals can't take advantage of flow through. People can write a check for $1,000 to the issuer or $5,000, but it's hard to run an exploration program on onesies and twosies.
Absolutely. So, what do you do? An issuer, it's not worth the legal fees unless the issuer is raising $1 million, $1.5 million. I mean, deals are done at less. Done at $300,000 and $400,000 at a time. But but in order to make it rational, an issuer has to have enough money in the till to enter into a drill program with some subcontractor.
Right, and then there's a window to it, right? It's not like you get the money, the investor invests now, the issuer gets the capital, and it has to be spent within a certain period of time. You can't sit on it forever.
No, and in fact, that's absolutely true. So if an issuer raises $1 million now in the middle of the first quarter of 2024, I think we're in 2024, some days, They will renounce, even if they haven't spent all the money by the end of this year, the investor still gets their deduction for 2024.
Right.
And the issuer has to the end of 25 to spend the money.
So the renunciation is a tax process, which is different from the actual going in the field and doing the work.
Right, but they have to go into the field and they have to do the work. So it's a flow through of an expense. So it's a Canadian exploration expense that gets flowed through to the first subscriber. And the only tax risk is that the issuer doesn't properly spend the money. And
Right.
CRA is very good at looking at these things. But generally, absent a CFO that is entire, like maybe the accountant you were talking about earlier, it's very rare that they don't properly spend the money. It's like we've done, in the last 17 years, we're well over $3 billion of flow. And
Right.
we've had 7 instances where we've had an issue. And in each case, there's an indemnity in the retail investor. Our investors got repaid out of it, and it wasn't exactly what everybody wanted to see happen, but nobody was hurt and everybody was happy.
And you hear the stories about a company getting behind. It's September. They can't spend all the money properly because they don't have a helicopter or whatever. And so they can joint venture that money into another project and honor their obligations that way.
They can earn into another project, absolutely. It's funny. I've gotten calls over the years, and somebody will say, the drill holes are like there's nothing there, and I have to spend the money. I go, no, you don't. Just pay back half the money to the under your indemnity and keep it as hard dollars.
Yeah.
So even there, they've got the ability, they've got the flexibility to deal with it with being true to the regime. It's a brilliant piece of engineering.
I've told people that every person in Canada who pays tax should invest in some flow through, even if it's only $1,000.
And that said, we've been lobbying. We have a full-time. We are a registered lobbyist, and we've been lobbying the federal government for a long time, and the provincial government in Ontario for a long time to expand the flow-through regime. Talking about Saskatchewan actually brought in a 30% additional tax credit.
Right.
So somebody in Saskatchewan who pays a fair amount of tax can say, by just using an easy number, $100,000 of flow through, get a 30% federal tax credit, get a provincial tax credit of 30%. There's a little adjustment to the federal one that's not important for this discussion, and end up with an after-tax cost of investment of around 30 cents on the dollar.
There's 30 cents at risk of the dollar that's been invested.
Until they go to sell the shares. At that point, there's a capital gain on the 30 cents. But even then, so even adjusted, their after-tax cost in investing in junior mining in Canada is 33, 34%. All these numbers, by the way, are on the PDAC website.
And your website as well.
And on our site as well.
So what you've also done is you've taken regular income and converted it to a capital gain, which is taxed at a better rate.
That's true. I prefer to think of it as my deduction in Toronto results of say $100,000 results in a taxable activity in Timmins.
Good pick from Timmins.
You're from Timmins. God bless Timmins. So, but that's the reality. Look at the first transaction of any size that gave our firm credibility was with Tony McCooch at Lakeshore Gold, and that was the first quarter of 2009.
But flow through is very egalitarian. It's not just for the big funds. It's not just for big investors. Everybody here at PDAC who's Canadian taxpayer should be writing a check to an issuer for flow through.
The problem is, how does the issuer access those checkbooks?
Yes.
So the brokers don't exist anymore, right? So do we need a tech platform to say, okay, you can come on, and then you have to go to the OSC and figure it out? But I mean, you would think that the evolution of retail investment, especially in flow through, would be through that mechanism. The only other way a retail investor can come into a flow through offering, if they want to keep the shares for investment, is through one of the flow through funds. But those flow through funds have not fared well over the last few years, and I think people are. Again, it's not a lot of money that's being used, that's being raised anymore through the flow through funds.
A lot of money is made during the down cycle.
Absolutely.
It's when the market is down. Be greedy when others are fearful.
A long time ago, at the very beginning before I even founded the business, I mean, somebody, an old timer in mining said, Ron, a little bit because you ran a fund for real estate. Mining exploration is just another real estate play. If you think of the person who buys farmland north of Toronto and brings it into the official plan and then gets it, and then gets it site approved for subdivision land, they don't have the capacity to build out the subdivision and spend $4,000 a foot in putting in the roads and the sewers. They sell to a developer, right?
Right.
Mining exploration is exactly the same thing. You know, a couple of geologists, folks get together, they find a claim, they add value to the claim. If there's gold in them, their hills, you know, they're going to have somebody further up in the food chain take it.
It's the mining upcycle.
Exactly. So right now everything's depressed. Gold is high, but the underlying equities are low. It's a great time to buy.
Silver's up $23, $24.
But the silver, I mean, look at the issuers. They're not, unless you're a producer.
Right.
But if you're an explorer, there doesn't seem to be any money in the system. You know, and now there's even greater uncertainty in this system, because there's concern around the table now that the mineral exploration tax credit, the broader historical 15% tax credit, isn't going to be renewed. And that will add to this AMT angst. It's the government's not being, you know, they've come here and they've said we are supportive of the industry, but on the tax side, they certainly haven't demonstrated that.
I always enjoy talking to you.
That's always a slice.
The road to mining in Canada goes through First Nations. Thank you for talking to us about flow through. Peter Clausi signing off from PDAC 2024.